Hello, today, in less than 5 minutes, KNG International Advisors will inform you about the international financial markets. This week's report is titled, Labor Market Reality Check Meets Market Resilience. The first week of September delivered the kind of sobering economic data that typically sends markets into retreat, yet equity performance told a different story entirely. The S&P 500 closed Friday up 0.3% for the week, demonstrating once again that markets possess an uncanny ability to look beyond headline disappointments toward underlying fundamentals that remain surprisingly robust. Friday's employment report showed non-farm payrolls increased by just 22,000 for the month, while the unemployment rate rose to 4.3%. This represented the kind of miss that in previous cycles might have triggered widespread selling. Instead, markets processed the data within the context of a broader narrative that continues to evolve in unexpected directions. The seeming contradiction between weak employment growth and market resilience reflects sophisticated investor understanding of what these numbers actually represent. After the S&P 500 set an all-time high of 6,532 in the market's opening moments, the subsequent recovery pattern suggested traders are becoming increasingly adept at distinguishing between temporary noise and structural shifts. What makes this employment weakness particularly intriguing is its timing rather than its magnitude. A softer employment picture provides the Federal Reserve with additional cover for maintaining accommodative monetary policy without the risk of overheating an already tight labor market. The central bank's delicate balancing act becomes easier when employment growth moderates organically rather than requiring aggressive policy intervention. The Morningstar U.S. Market Index rose 0.42% for the week, with sector rotation continuing to reflect this nuanced economic backdrop. Technology outperformed, suggesting investors remain confident in structural growth stories, while cyclical sectors showed mixed performance, indicating selective rather than broad-based concern about economic momentum. Corporate America has demonstrated remarkable adaptability throughout this cycle, adjusting workforce strategies to match evolving demand patterns rather than engaging in the boom-bust hiring cycles that characterized previous decades. This evolution may mean that traditional employment metrics require new interpretational frameworks to accurately gauge economic health. September's arrival brings the familiar chorus of seasonal pessimists warning of the month's historically weaker performance. Yet this seasonal narrative, while statistically accurate, often obscures more important investment considerations. With central banks globally signaling potential rate cuts and fiscal policy remaining supportive, the economic backdrop hardly matches the gloom that seasonal patterns might suggest. The current market environment also presents interesting valuation disparities that reward selective analysis. While the Magnificent 7 inches technology stocks command premium valuations, other sectors trade at more modest multiples. Energy companies, despite structural growth drivers, remain attractively priced relative to technology. Consumer staples provide steady cash flows and defensive characteristics that become particularly attractive when markets reach elevated levels. The test of current trends will come as more economic data provides clarity on whether September's employment weakness represents temporary softness or meaningful deceleration. For now, the market's response suggests confidence that the underlying economy possesses sufficient resilience to navigate this transition successfully. As we move deeper into autumn, the fundamental investment case remains intact: a gradually cooling but stable economy, corporate earnings that continue to grow, and monetary policy that provides support without fueling excess. For investors, the lesson remains clear: avoid being swayed by seasonal noise and maintain focus on the long-term drivers that ultimately determine market direction. Value opportunities continue to reward patience, with those who resist the temptation of chasing headlines positioned to benefit from persistence and compounding returns.